the market gets a head of steam based on optimism. It gallops ahead on further good news. One or two negatives come in, but the market finds it very easy to reject those and exclude them from their thinking. A part of it is because the general trend is still positive, but part of it is because of something called cognitive dissonance. And you know, cognitive dissonance is something that you should all familiarize yourself with. And it is basically the human brain's ability to reject information which is at odds with its predisposition. So, you know, the market is riding on optimism, rising continuously. The good news is incorporated and causes price to go higher. Bad news is ignored. And then, at some point in time, for some reason or no reason, a kind of a critical mass of negativity arises, and it overcomes this predisposition to be optimistic. By the way, I believe that there is a predisposition to be optimistic. Not pessimistic, optimistic. Why is that? Because you have to be optimistic to be an investor. What is investing? You take your money, you give it to somebody else in the hope you'll get back more later. So if you think about it, it has to be built on optimism. But sometime enough kind of critical mass of bad news to knock this process off stride. You know, one thing you have to bear in mind, as I say, in real life, things fluctuate between pretty good and not so hot, but in the minds of investors, they go from flawless to hopeless. And the psychology swings to the extreme. First, they like them too much, then they hate them too much. And you don't want to be caught on the wrong side of that, or you don't want to be part of that movement. I really believe that there's been a slight turn from optimism to pessimism. We're certainly not suicidal, depressed, and it's hard to gauge where the market is. But one thing we look at is the price-earnings ratio on the S&P 500. You know, it was probably 23 times. Now it's probably 22 times. Still very high. His historic average is between 16 and 17. So it's still high priced, but they are cheaper than they used to be. And that should be encouraging. Are we at the bottom? Well, that's like the stupidest question in the world. I mean, you never know when you're at the bottom. What is the definition of the bottom? Think about it for a minute. What is the bottom? Zero. Pardon me? Zero. No, not zero. Nothing goes to zero. But the bottom is the day before it starts going up. Right? And if that's true, then by definition, you never know when you're at the bottom, because you can only tell the next day. So I think one of the dumbest things you can do in the investment business is to say, I'm going to wait for the bottom. Because logically and practically, you'll never know. You can tell when things are cheap. You can't tell when the day has been reached that it's never going to go down anymore. You know, prior to the 60s, people investing in the stock market were called investors. There were no different kinds of stock market investors. Then, around the beginning of the 60s, Wall Street, I remember seeing a brochure in my dad's apartment in around 62, talking about something called growth stocks. And the concept of growth stocks was invented. And these were companies that looked expensive on the basis of their current assets or earnings, but had brilliant futures. They were either in tech or biotech or, you know, technological advancements, or they were great consumer companies. So you had Xerox, IBM, Kodak, Polaroid, Hewlett Packard, PerkinElmer, Texas Instruments, Merck Lilly, or you had Coca-Cola, for example, Sears Roebuck, et cetera. Companies, a growth company, all companies grow. Growth companies grow at above average rates of growth. And so the growth stocks started to attract attention. People started to specialize in the growth stocks. So, as humans do, to categorize themselves, they want to put labels on. So the people who did not invest in growth stocks called themselves value. These are growth stocks. They grow faster than the average company. These are value stocks. They're cheaper than the average company. So that became the dichotomy. And so some people buy the growth stocks, some people buy the value stocks, but with this firm divide. And Andrew and his family moved in with us during the pandemic, and we got to exchange a lot of ideas. A lot of them were on this subject, and I crystallized them in a memo I wrote in January of 21 called Something of Value. But the bottom line was, it shouldn't be a bifurcation. It shouldn't be either or. You can make a intelligent investment in a company with a high rate of growth or in a low rate of growth. And you should pay a price which is appropriate for the rate of growth. But just because a company is fast growing doesn't mean it can't be a good value investment. And you got to get away from these hard, exclusionary definitions. And I think I was right.
Every trade's two trades.
Yeah.
So there's a question of buying and there's a question of selling.
Yeah.
How do you map your logic to discipline in selling?
I wrote a memo called Selling Out. And I said in there, why do people sell? You know, and you read 100 articles and books and analyses on whether to buy something. There are very few on whether to sell it. And half facetiously, I said they sell for two reasons. Because it went up and because it went down. If it goes up, they sell it because they're afraid that it's going to stop going up or maybe go down, in which case their profits will evaporate. And if it goes down, they sell it because it scares them and makes them think it might go down more. Now, if you think about it logically, it can't possibly be right to sell because it went up and to sell because it went down. And I think in this memo on Selling Out, I told the story of Amazon. And as I recall, yes?
Yep.
I think Amazon was 90 in 99 on the tech bubble. And then when the bubble burst in 2000 or 2001, it was 6. So it went from 90 to 6. It was down 93%. So what if you were smart enough to buy it at 6? Would you have held it at 12? Or would you have said, well, I've doubled my money. I'm going to take some off the table. And let's say you held it at 12. You're tough. What about when it got to 60 and you've made 10 times your money? Would you sell it? Most people would. What about when it got to 600 and you made 100 times your money? Would you sell half? Would you sell 3/4? Would you sell 90%? And, you know, at the time I wrote it, as I recall, Amazon was 3,300. So if you sold it at 600 when it was up 100 times, you left basically 85% of the money on the table. So it should not be your natural inclination to sell because things are up. And, you know, Buffett says he made all his money on 12 ideas. Guy invested for 70 years. He says he made all his money in 12 ideas. Charlie Munger, who was a friend of mine, Warren's partner, used to say he made all his money in 4 ideas. He didn't have as many good ideas as Warren. So if you tend to think that a great idea, or what nowadays they call a compounder, if you realize how scarce they are, and that you're not going to find a lot of them, then the big mistake is getting off too soon.
So are we in a world where we should be stretching? Or are we in a world where we should be thinking about making money by not losing it?
One of the influential things I read was 1974. There's a guy named Charlie Ellis, and Charlie wrote an article called Winning the Loser's Game. There was a guy named Cy Ramo, who was the R in TRW, and he wrote a book. I'm a tennis player, and he wrote a book, Extraordinary Tennis for Ordinary Tennis Players. And he he made an interesting observation. He said that in professional tennis, in championship tennis, the person who wins the match is the person who hits the most winners. If you hit a ball back gently, your opponent will hit a winner and put it away. You'll lose every point. So you have to go for winners. But of course, you have to have the skill to execute. But at the amateur or club level where I play, the winner of the match is often the person who hits the fewest losers. Because the club tennis player doesn't have the ability to hit a lot of winners. And in fact, many don't have the ability to keep the ball in play. So I believe that if I can just hit it back over the net 20 times, my opponent can't, and I'll win the point. I don't have to hit a winner. I just don't have to hit any losers. So Charlie Ellis took this idea to investing. Should you go for winners, or should you try to avoid hitting losers? And that appealed to me, and given my chicken nature, I said, well, I can win by not hitting losers. So when we set up Oaktree, we wrote down the investment philosophy. Number one is risk control. Number two is consistency. It's all about avoiding the losers. But it's a choice that everybody should make based on their skill level. If you aspire to be a championship player, you should learn how to hit winners and then try to do it. If you don't learn how to hit winners and try to do it, you'll never become a champion. Of course, most people can't. So you have to pick your course, but it has to be the right course for you. Not for me, not for you, not for your parents, but for you. Yeah. And a lot of life is figuring out what you're about and then pursuing life accordingly.
Yeah.